Are we still optimistic on these markets? Well, businesses seem to be still optimistic. Jay Hatfield's with us, Infrastructure Capital Advisors, CEO and Portfolio Manager. Jay, what do you make of where we are in the markets at the moment in terms of valuations? Because from Citigroup, from Morgan Stanley, whether over at Bank of America, Merrill Lynch, also all these strategists coming out saying, look, this doesn't look as pretty. It's hard to substantiate some of these valuations.
Well, we don't disagree with caution at this point. We're very focused on 2022, and we don't see the market being overvalued. We prefer to look at the Dow multiples because then you don't get Tesla and other money-losing companies. It's trading about 18 times, which looks fair relative to bonds, but we're concerned that there could be headwinds to those earnings because we see stagflation in 22, driven by increases in corporate taxes and a huge, up to $2 trillion fiscal cliff. So we think caution's warranted. The only caveat to shorting or panicking at this point is it's really hard. There's going to be selling in the fall like there always is, but it's going to be extremely difficult to offset that $120 billion that the Fed is investing in the capital markets every month. So we see probably in the fall the market being range bound, but not necessarily breaking the uptrend it's in. And really that may require a substantial tapering, because you really just can't offset that $120 billion coming in the capital markets every month.
So then how do you offset a 133 on the 10-year? Does that look attractive, given, of course, the Fed's involvement in the bond markets and, well, an equity market that may be range-bound?
Well, we see inflation accelerating next year, even potentially, into the high single digits. You could argue right now it's already in the high single digits if you correct for rent inflation. So there's no way the Treasury should be at in 135 in this range. But with global QE, it's just like all asset class, Bitcoin, everything, it's hard for it to really find its fair value. So we believe Treasuries are probably overvalued here, but in terms of actually shorting them, that's more problematic, I would say, again, given the fact the Fed is buying.
Yeah, absolutely problematic to say the least. I want to go back, Jay, here to something that Michael McKee was talking about with regards to what was in the Fed Beige Book. The idea here that some of the supply chain issues are having an economic drag, at least as measured by those surveys in the Beige Book here. And we've heard anecdotally from several companies, including in the housing sector, the automotive sector, even in the medical device sector, that they're actually seeing business hurt by this, that they're actually having to either scale back their production or turn away customers because they can't sort of meet the demand or meet their own supply and input needs here. And I'm wondering how much of this do you think is longer term and how much of this should be factored in to investor strategies?
Well, we see it not just being a pandemic supply chain shock, but overstimulation of the economy by the federal government and the Fed. And so that's making this what would be a small supply shock into, in certain cases, a hyperinflation. So steel, nobody ever seems to focus on it, but it never goes down. It's up 200%. So it is literally in a hyperinflation. So we think it is a big problem, and it's going to be a contributor to stagflation, probably slowing growth into the rest of the year, but potentially 0 to 2% growth next year as we have inflation pressures, disrupting the economy.
Jay, are you therefore looking for inflation hedges if you feel that inflation is moving, if you're worried about, fighting the Fed when it comes to asset prices, but are you hedging in any way?
Well, there's one, I don't know if it's necessarily a direct hedge, but there's one commodity that we're very bullish about, which is natural gas, which is also timely because it's up almost 8% this year, today, and at 7-year highs. And the reason for that is that it really is the key to the hydrogen economy, in that there's 4 hydrogen atoms and 1 carbon in natural gas. So it's by far the most efficient way to transport natural gas. It lowers the liquefaction point from negative 450 to 225 degrees Fahrenheit. And LNG prices natural gas prices are 4 times as high in overseas in Japan and the UK as they are in the US. So we think that it's not really a direct inflation hedge, but that's a commodity that has good long-term fundamentals, because the best way to really deal with climate change is to shut down coal and substitute in hydrogen/natural gas.